Well, Illovo has reported a 43% rise in full-year headline earnings per share to 190 cents. This as the company benefited from a record cane crop. Sugar production increased 14% to 1.7 million tonnes, and a total distribution of 95 cents has been declared. That's up 44%. I caught up with the company's CEO, Clarke. Let's take a look.
We have put in a lot of work actually in consolidating the operations, so we're very pleased with the result. I think it comes off a solid platform in terms of getting our production right. Production's nicely up year on year. To finish at 1.75 million tonnes of sugar is a great result, and that's really been driven off better cane supplies to our factories. We ourselves produced a record cane crop from our own operations. Our growers did very well and also increased their deliveries. So all up, I think we crushed nearly 15 million tonnes of cane, which was a great result for us. And our factories ran well. We put in a lot of work in getting our efficiencies right, getting our recoveries right, and we're very pleased with the way the factories performed. So the net result was more cane, better factory performance, so a better production result.
That within what context, Graham, in terms of the demand scenario, because you're emphasizing here very much the supply side of things. So what demand are you catering to?
Yeah, I was going to go on to say it doesn't stop there, because you've got to convert that into revenue, and then you've got to take your cost base into account to get your margin result. And I think we have seen an increase in our operating margin, a nice increase from 14.7 up to 17.1%. So yeah, we operate predominantly to supply local markets. 60% of our volume is sold into local markets in the countries in which we operate. And then the balance is exported primarily to neighbouring countries where we enjoy a geographic freight advantage. So we get a better ex-mill factory price relative to competition. We also supply a large volume into the European Union under preferential trade arrangements, enabling us to take advantage of that high-priced market over in Europe. And there's a very small residual balance that goes on to the world market, which tends to be the market where residual sugar is traded. But if you average all that together, we have a very nice spread of markets, and I think it was very pleasing to see that improvement in our revenue line as well. As I say, you then have to take costs into account. And a lot of work has gone into addressing our cost base, things like central procurement and trying to get leverage off the group's purchasing power in terms of things like fertilizers, agricultural chemicals, factory spares and that sort of thing, all designed to get the unit cost down. We've invested in a state-of-the-art warehouse and distribution centre in South Africa. That in turn will reduce our rental costs for warehouses and reduce our transport costs. So it's a bit of it's a combination, if you would like, that sort of it manifests itself in an improved operating margin. You take all that down to the bottom line, and a 43% increase in headline earnings was a great result for us.
How close to full capacity are you operating right now, and what are your capacity plans moving forward? Because just last week we had Tongaat saying that it has the capacity to increase production. So how does your capacity compare?
Yeah, listen, we've been very fortunate. We work hard on filling our factories up. There's nothing worse than investing in a plant and then not running it at full capacity. That's a waste of capital. So we tend to operate very close or above capacity in some cases, and generally we like to invest to further expand our factories if we want to increase our throughput and capacity. In South Africa there's a little bit of headroom, as you're probably aware. We are recovering from a period of drought that saw last year being closer to a more normal year, and cane supplies will increase again in the coming year, which should fill our factories in South Africa up quite nicely. Elsewhere, though, we're pretty close to capacity, and as we grow cane supply, we have to marginally increase the capacities of our factories. So we like to run on very full factories all the time.
And where you've benefited from favourable, domestic and regional pricing then during the year, as you highlighted a short while ago, what's your outlook then on that front?
Yeah, I think we are entering into a period where markets will turn. Markets go up and markets go down. But we are seeing the world sugar price trading down at the moment, and that inevitably will lead to some erosion in the regional price of sugar, where we do supply a fair old tonnage. Also, we see price pressure coming through in Europe now as the price is starting to fall slightly. So yeah, I think we're going to have to work really hard on maintaining our revenue line. You know, we tend to price sugar locally to match inflation, if you would like. So what we lose out on export markets, it's unlikely we'll recover domestically. So we have to work hard on new markets, perhaps new customers, and then in order to maintain our profitability, to sort of do some more of what we've done on our cost base.
What about greater diversification on your product line as well? Because currently we've got sugar production contributing, 55% to your operating profit, but perhaps there's a little bit more room to play on the power generation side, you know, your downstream side of things as well. How much room do you have to maneuver on that front?
Yeah, that's a very good point. We like to think we take a stick of sugar cane and we take whatever we can from that stick of cane, and it's not only sugar. So we take what the residue left after crushing cane, the fibre, we use to drive power generation plants. And this past year we produced more than 90% of our own power requirements in our own factories. So we aim to be self-sufficient first and foremost, and then where it makes commercial sense, then to export into national grids. We did that last year in Swaziland and in Zambia, and we certainly will look to expand that into places like Malawi and Tanzania going forward. So power generation does give us the potential to enhance earnings going forward, but we will have to invest in power plant, and that's generally not a cheap investment. You're talking several $100 million at a time. Excitingly though, in the ethanol and alcohol side of the business, we're just commissioning now a brand new plant in Tanzania that will be a state-of-the-art, high-quality alcohol producer. And that's an area that we're pushing more and more into, where we take molasses, which is another byproduct or residue from the sugar process, and now ferment and beneficiate that into high-quality alcohol for industrial use and for potable use in the beverage industry. And more we'll look at the production of fuel ethanol to go into to fuel blending, as places like Zambia and Malawi, who have to import all of their fuel, it makes a lot of sense to try and supplement that locally. So you're dead right. We have projects under development in all areas there.